The Ontario housing market, once seen as a guaranteed path to wealth, is now flashing red warning signs that can't be ignored. For years, home prices in Ontario, especially in cities like Toronto, Ottawa, and Hamilton, soared to levels that most families could never afford. But what goes up eventually comes down, and the cracks in the foundation are already showing. One of the biggest drivers of this looming crash is interest rates. For over a decade, Ontario homeowners enjoyed cheap borrowing costs that made million-dollar mortgages seem possible. But with interest rates climbing, thousands of homeowners are now facing mortgage renewals that could double or even triple their monthly payments. Families who once stretched themselves thin just to buy are now at risk of default. This isn't just a personal problem. It's a systemic one. Add to this Ontario's household debt crisis. Canadians already carry some of the highest household debt in the world, and Ontarians are at the top of that list. When housing prices stagnate or fall, people with massive mortgages can quickly find themselves underwater, owing more than their homes are worth. That's when panic selling begins and markets spiral downward. Another warning sign? Investor-owned properties. Over the last few years, speculators bought up homes and condos across Ontario, hoping prices would continue to skyrocket. But with rents not keeping pace with interest rates and affordability at rock bottom, many of these investors are cash flow negative. If they start unloading properties en masse, the oversupply could trigger an even deeper collapse. Meanwhile, ordinary Ontarians are already being priced out. Young families are fleeing the province for cheaper alternatives like Alberta and the Maritimes. The demand that once kept Ontario's housing market red-hot is now slipping away, leaving sellers with fewer buyers and homes sitting on the market longer. The truth is, Ontario's housing market is no longer untouchable. The signs are all pointing in one direction, downward. By 2026, experts warn that we could see a full-on housing correction, with prices falling dramatically, equity wiped out, and affordability still out of reach for many. The question isn't if Ontario's housing market will face a reckoning. It's how bad the fallout will be when it hits. Toronto, Canada's largest city, is now facing one of the harshest rental crises in its history. Rents are skyrocketing to record highs, yet wages have remained flat for years. For ordinary people, the math simply doesn't work anymore, and the dream of living in Toronto is slipping further out of reach. Let's start with the numbers. The average rent for a one-bedroom apartment in Toronto has climbed to levels most full-time workers cannot afford. According to housing data, rents have surged by double digits over the past few years, even as inflation cooled in other areas. Yet, the average income in Toronto has barely moved. People are paying more, but not earning more, and that gap is stretching families to the breaking point. What's fueling this rent surge? Demand far outpaces supply. Toronto's population continues to grow through immigration and urban migration, while housing construction lags behind. Developers are struggling with rising material costs, higher interest rates, and restrictive zoning laws. As a result, fewer new units are hitting the market, and renters are left fighting over limited inventory. Speculators and corporate landlords are also a big part of the problem. Large investment firms have been buying up apartment buildings and homes, raising rents aggressively to maximize profits. When ordinary families compete against billion-dollar companies for a place to live, it's no surprise who ends up winning. For young professionals, students, and newcomers, the crisis is hitting hardest. Many are forced into cramped apartments, long commutes, or even moving back in with family. Others are leaving Toronto altogether, searching for more affordable cities where wages go further. This exodus is slowly reshaping Ontario's demographics and economy. The long-term danger? Toronto risks hollowing out its middle class. When teachers, nurses, and essential workers can no longer afford to live in the city, services decline and inequality deepens. The very people who keep Toronto running are being pushed to the edges. For now, the city shows no signs of relief. Without major changes like building more affordable housing, regulating rent hikes, or addressing speculation, the rent crisis will only worsen. Toronto may be Canada's financial capital, but for ordinary renters, it's becoming unlivable. For years, Ontario's housing market seemed unstoppable. Prices doubled and tripled in some regions, turning ordinary homes into million-dollar properties. People called it an investment, a retirement plan, even a guaranteed path to wealth. But bubbles don't last forever, and Ontario's housing bubble is now showing clear signs of bursting. At the heart of this bubble is speculation. Investors and even everyday buyers believe prices would rise endlessly, leading many to stretch their budgets or take on massive debt just to get into the market. Pre-construction condos sold out in hours, with buyers flipping contracts before a shovel even hit the ground. It created an illusion of limitless demand, but demand built on speculation is fragile. Then came interest rates. For a decade, ultra-low rates made mortgages feel manageable. When rates began to climb, the foundation cracked. Homeowners who bought at the peak suddenly faced renewal payments that were 2 or 3 times higher. The very fuel that fed the bubble, cheap money, was taken away. Another factor, income levels simply can't support it. The average family in Ontario cannot afford it. When affordability falls this low, the market becomes unsustainable. Eventually, buyers step back, listings pile up, and sellers are forced to slash prices. We're already seeing it. In suburban markets around Toronto, homes sit unsold for weeks, something unheard of just a few years ago. In smaller Ontario towns, the pandemic boom is reversing, with prices falling sharply as demand cools. Investors who once snapped up properties are beginning to panic as their rental income doesn't cover higher mortgage payments. The psychology of the market is shifting too. For years, FOMO, fear of missing out, drove buyers. Now it's FOP, fear of overpaying. When people believe prices will fall, they wait on the sidelines, and that hesitation only accelerates the decline. Ontario's bubble isn't just about high prices. It's about the disconnect between housing and reality. You can't have endless price growth in a province where wages are flat, debt is sky high, and supply remains limited to speculative building. The unraveling has begun, and it's a reminder that even the hottest markets can cool. The question now is how deep the correction will go. Will it be a slow decline or a sharp crash that reshapes Ontario real estate for years to come? Either way, the bubble is bursting, and Ontario's housing market may never look the same again. Ontario homeowners have long treated their houses like golden tickets. For decades, real estate prices in cities like Toronto, Ottawa, and Hamilton soared so high that even modest properties turned into million-dollar assets. But the reality is shifting fast. By 2026, experts warn that billions of dollars in homeowner equity could vanish as Ontario's housing market faces one of its biggest corrections in history. Equity is the difference between what your home is worth and what you still owe on it. When housing prices climb, equity builds. But when prices drop, equity can disappear overnight. Many Ontario families bought homes at the peak of the market, taking on massive mortgages under the assumption that values would only rise. Now, with interest rates higher and demand slowing, those same families could find their homes worth tens or even hundreds of thousands less than what they paid. One of the main drivers of this looming equity wipeout is rising mortgage renewals. Thousands of Ontarians are coming up for renewal in 2025 and 2026, and they'll be facing payments 2 to 3 times higher than before. For some, this will mean selling into a market that is already cooling, pushing prices down further. For others, it could mean falling behind on payments and risking foreclosure. Both outcomes drag values lower, hurting everyone in the market. Investors are another key part of the problem. Many purchased condos and rental properties on razor-thin margins, counting on appreciation to make it worthwhile. But as rents fail to keep up with rising borrowing costs, these investors may start dumping properties. A flood of listings means prices will fall even faster, cutting into homeowner equity across the province. The ripple effects go beyond just the housing market. When people feel poorer because their home value drops, they spend less. This wealth effect could impact Ontario's economy, from retail to construction jobs, making the downturn even sharper. By 2026, billions in paper wealth could be wiped out. For homeowners, That means less security, fewer borrowing options, and in some cases, negative equity, owing more on the mortgage than the house is worth. For Ontario, it's a stark reminder. Housing markets don't just rise forever. They correct, and when they do, the fallout is felt by everyone. Ontario has always been the economic engine of Canada, drawing people in with job opportunities, world-class schools, and vibrant cities. But today, something very different is happening. Families are no longer rushing into Ontario. They're rushing out. Record numbers of people are leaving the province, and the housing crisis is at the heart of it. Why are families leaving? The biggest reason is affordability. Home prices in Ontario have climbed so high that even dual-income households can't afford to buy. In cities like Toronto, the average detached home costs well over $1 million, far out of reach for most families. Renting isn't any better. Rents continue to climb, leaving little money left over for savings, childcare, or even groceries. For many, the choice has become simple: leave Ontario or face a lifetime of financial struggle. The cost of living gap is widening between Ontario and other provinces. Families are finding they can sell their Ontario homes and buy bigger properties in places like Alberta, New Brunswick, or Nova Scotia, often with money left over. Even renters are moving, drawn by cheaper housing markets and lower day-to-day costs. This internal migration is draining Ontario of its middle class. The impact is already being felt. Employers in Ontario are struggling to fill roles because workers simply can't afford to live near their jobs. Nurses, teachers, and skilled tradespeople are leaving for provinces where they can own a home and raise a family without being crushed by debt. This trend threatens Ontario's long-term growth, as fewer families mean fewer workers, fewer taxpayers, and fewer consumers. For those staying behind, the situation isn't getting easier. With so many people priced out, some families are forced into multi-generational living, long commutes, or overcrowded rentals. Meanwhile, developers continue to focus on luxury condos, leaving affordable family housing in short supply. Ontario's housing crisis is no longer just about numbers. It's about people's lives. The steady exodus of families is proof that the system isn't working. Without bold solutions, such as building affordable housing at scale, addressing investor speculation, and rethinking zoning laws, Ontario risks losing not only its families, but also the future stability of the province itself. Ontario's housing market has not just been influenced by domestic demand, but also by international money flows. Over the last decade, global investors have turned cities like Toronto, Ottawa, and Mississauga into safe havens for their capital. Real estate, unlike volatile stocks, has been seen as a solid investment, particularly in Canada, where the economy and political stability have made it a global hotspot for wealth preservation. While this may sound positive, the long-term consequences for local buyers have been devastating. Foreign buyers often purchase properties not to live in them, but as assets to hold, sometimes leaving them vacant. This removes supply from the rental pool and drives up both home prices and rents. For many Ontarians, this has created an environment where locals are effectively competing against billionaires and overseas funds, a battle they cannot win. While the federal government has recently introduced restrictions on non-resident ownership, many loopholes remain, and corporations still find ways to funnel international money into Canadian real estate. The consequences are visible. Condos being snapped up in pre-construction phases by foreign investors, detached homes being left dark for months at a time, and rental units priced far above what local salaries can support. In cities like Toronto, young professionals working full-time jobs in healthcare, education, and government cannot compete with speculative money flowing in from abroad. This has turned the dream of homeownership into something almost mythical for millennials and Gen Z. Supporters of foreign investment argue that it injects cash into the economy and boosts construction. But the reality is that it also drives a wedge between wages and housing costs, making Ontario's affordability crisis worse year after year. Builders are more likely to build luxury condos for investors rather than affordable homes for working families, because the profits are higher. Ontario is at a crossroads. Policymakers need to decide whether housing is a commodity for global investors or a necessity for local residents. Without stricter regulations and bold action, international capital will continue to shape Ontario's real estate market in ways that push locals further out of reach. If the province wants to restore balance, it must prioritize people over profits.